This computer.
Need to clean up the beginning of it, that's all.
Let's see if it records mine. Oh, mine is recording. Okie dokie. All right.
Same
We'll let
account.
it go. Little pre-game show.
All right, let them in. Did you say let them in? Okay. Hmm. I don't get the let in.
Attendees. Oh, it looks like they are maybe already in. Let's
Oh,
see.
we are. They're in. They heard everything.
Sorry, you just been enjoying our little little conversation.
Banter.
Technical difficulties, Just trying to work out all the kinks. Oh dear. Awesome, awesome. Let me make sure.
Well, since you're all in and been listening to us, thank you for being here. Go ahead and put in the chat where you're coming in from today. Age of your kids would be helpful too, just so we know who was in the audience today.
Oops, is that not working? There we go. Yes, welcome. Welcome, everyone. Thank you very much for joining us. Michael Bowman, welcome from Dallas, who's got a 9, a 12, and a 15-year-old. Thanks for joining us, Michael. Linnea from California, a 20-year-old. Welcome, Linnea. James, Troy from, or it looks, I guess, Troy from Michigan. Charlotte is 19. Perfect. Sri Hardy, I think, New Jersey, 19 and a 16-year-old. Welcome. Thanks for joining us. Looks like everybody's getting logged in. We've got about 5 minutes. We've got about 5 minutes to go until it's showtime, but thanks for joining us early. Excited to have you. If you are just joining us, go ahead and put in the chat where you're from and the ages of your kids. Carol, welcome from Pittsburgh, Pennsylvania, with an 18-year-old. Thanks for joining us, Carol. Excited to have everyone on. Who is excited to learn how to get free money for college? Anyone? Anyone? Raise your hands. Practice the emojis. Let's see if we can get those emojis working on there. Brian from Virginia, 16 and 18-year-old. Looks like Carol's excited to get some free money. Awesome. Thanks, Carol. Jean from California, 17 and 16-year-old. Thanks for joining us, Jean. Awesome. This is going to be fun. Deborah Freeman. Hello, Deborah. Welcome, welcome from Colorado. Our neighbor over there. And welcome from Virginia, 19 and 16-year-old. Allison from Texas. Looks like we've got some twins, 18, 18, and 20. Welcome, Allison. Jackie from New York, 15 and 19. Welcome, Jackie. Might see up a little bit. There we go. All right. I'm assuming everyone's hearing me and seeing me okay, because you're responding, so I guess that's a good sign. We got the technology working. If you are just joining us, welcome. We've got about 4 more minutes. This is the pregame show. Your host, Lance Morgan here, coming to you live to learn how to get free money for college. Perfect, perfect. Okay, so if you're just joining us, let us know where you're from. Let us know the ages of your kids, and let us know if you're excited to learn how to get free money for college. We are live. I hope you have your questions ready. I also hope you have a comfy seat and a drink and a notepad to take notes, because we're gonna fly. We're gonna fly through some information. It's going to be super fun. I am super excited about it. All righty. Oh, okay, you're gonna have to help me. Wotek? Is it Wotek from Virginia? I hope I said your name right. Thanks for joining us. Okay, perfect. We'll text. Nice to meet you, Sean from Virginia, 17 and 15-year-old. Thanks for joining us, Sean. All right. That over. All right, WoTech has a 13 and 17-year-old. Welcome, Victoria from Northern Michigan, 16-year-old. Welcome, Victoria. All right, just a couple more minutes. We'll let everybody get logged in here. Bradley, 19 and 17-year-old from North Carolina. Thanks for joining us. Eric, 17 and 15-year-old from Iowa. Eric, what part of Iowa are you from? My wife is from Iowa. I lived in Iowa about 8 years. Yeah, right in the Des Moines. Excellent. I lived in Des Moines as well. My wife was going to school up in Ames, Iowa, good old Iowa State. That's cool. Welcome from Des Moines, Eric. All right, Sean. Thanks in advance for your presentation. Hey, thank you. Thank you for joining us. It's so much more fun when we have a live audience. This is going to be fun. And we have a huge group registered with us today. So we're excited about that. All right, let's see here. Eric, go Cyclones. That's right. All right. Whale. Oh man, how do you pronounce that? Whale. 19 to 14-year-old from Long Island. Sorry for slaughtering your name there. Thank you for joining us. DM 17 from Connecticut. Awesome. Let's see here. Gregory, thanks for joining us from Maryland. 18, 16, and 14. Tasha from Pennsylvania, 17-year-old. Adrian, a junior. Welcome, Adrian. Thanks for joining us. All right. We got Gina, 17-year-old from California. We've got Ivan from Maryland with a 16-year-old. All right, looks like everyone's starting to get logged in. It is go time. It is time to get started. We'll give everyone just a minute to get logged in. Again, if you are just joining us, we had a little pregame show there where we worked out the technology and everything. So thanks for joining us early. If you joined us early, we've been making sure the chat works. Get used to the emojis and the chat. We are going to be using the chat in this webinar. We are live. And so there are some benefits, of course, of being live. We're going to be able to get some feedback, and we're of course going to do a Q&A at the end. I've got all night, so we're gonna answer any questions that you have, and we'll take as long as we need. Hope that works. There we go. We'll take as long as we need to make sure we answer all your questions. So make sure you jot down all your questions. We'll get to those at the end. Again, if you are just joining us, we're going to get started in just a second. It is at the top of the hour here, so we'll get started soon. But again, thanks for joining us. We're going to be talking about how to use real estate and other tax strategies to get free money for college. I'm Lance Morgan. Super nice to have you on here. We have a huge group and counting. Looks like everyone is joining in. We had over almost 800 people register for this webinar, and I know everyone is just getting logged in now. So I just want to give everyone a minute to get logged in. But go ahead and put in the chat where you are from, and put in the chat if you are excited to learn how to get free money for college. Put that in the chat. Tell me what you are the most excited to learn about. What email piqued your interest? What topic are you excited to learn about? Let's blow up the chat so that I can see what you guys are excited to learn about. Maureen is asking about a replay. No, there's not going to be a replay. That's why you're here live. So thanks for joining us live. And then maybe if you're lucky, we'll do this again in the future. But we are doing this live without a replay so that everyone would come on live and we can answer questions and everything else. So Scott from Kansas, welcome. Kenny from Maryland, welcome. Eric, wahoo. All right. Alessa, Baton Rouge, Thomas, Carbonell, hello, Tomas. Good to see you, Tomas. Grapevine, Texas, 16-year-old. Matthew from New Jersey. Yamini from Atlanta. Matt from California. Cut out those taxes. Yes. Amen, Matt. All right. Susan from Pennsylvania. Manjusha from Savannah. We've got uh, Jalessa paying for LSU. Oh, we need to help with that. Tammy from Pennsylvania. Jennifer from Seattle. Daniel from California. Dolly from Sacramento. Chris from Connecticut. Kipling from DFW. Veronica. Okay. All right. I got way behind on the chat. Holy cow. Okay. Looks like everybody's getting in. I got a little behind on the chat. I'm going to just dive right into it. Keep putting your comments in the chat. Excited to have you on here. Welcome. If I didn't say your name, I apologize, but welcome. Thanks for joining us. And I am excited to dive into this topic. So I want to just dive right in, if you don't mind. Let's get started. So let's talk about how to use real estate and other tax strategies to get free money for college. I know that's a big promise, a lot to talk about. My name is Lance Morgan. Nice to meet you. If you've never been on one of my webinars before, thanks for joining us. We like to have a lot of fun, fill you with lots of information, and answer all your questions. So thanks for joining us live. It's probably pretty obvious why I'm pretty passionate about this topic of getting free money for college, reducing the cost of college, helping kids pay for college, because I have 5 lovely kids, with the 2 oldest in college, with the next 2 in high school, and my little guy is in elementary school. So I'm going to be doing this for a while, and I am in the thick of it as we speak. So I have been passionate about this topic for a long time. In fact, I actually left the IT industry and got into the financial services industry, trying to learn some strategies on how to best save and pay for college, as well as, make sure I was on track for retirement and everything else. Just became really passionate about the topic of finance. However, what I found and what I'm going to share with you on this webinar, I did not learn in the financial industry. In fact, that's why I called my company College Funding Secrets, because everything that I have learned, I did not learn in the traditional financial industry. And so my mission as a company is to help every family send any student to any school of their choice without having a negative impact on their retirement. Every family, that means high-income families, low-income families. In this particular webinar, we are going to talk about how high-income families can get free money for college, even though you think you don't qualify for financial aid. Any student means that whether your students are exceptionally gifted students or gifted in other ways. I have 5 kids. I know that some of them are gifted in other ways, maybe not as academically gifted. Any school, I don't want to just say, oh, you can get free money if you go to this school. We want to show you how to maximize the free money from all the schools. And of course, we want to do this and help you to not have a negative impact on your retirement. So you can actually help your kids pay for college without having a negative impact on your retirement. I know that's a lot, that's a lot to accomplish. So we're going to dive right in and show you how to do it. We're also going to talk about why you shouldn't pay for college with 529 accounts, cash flow, or whole life, or savings, or retirement, but instead, you should use real estate and other tax strategies to get free money for college. That is the goal, is to maximize the free money for college. Okay, so we are going to use real estate in this webinar to show you, as well as some other tax strategies. But there are 10 reasons why you might want to own real estate: cash flow, appreciation, depreciation, tax savings, mortgage pay down, leverage, meaning you can borrow against it, lifestyle asset, if you've got a condo or a cabin in the mountains on the lake, tax-free retirement income that you can use for retirement, multiple exit strategies. But here's the one that most people don't think of: free money for college. And I'm going to explain how that works. In addition to, of course, leaving a legacy. Leaving real estate to your kids is a great way to pass on to the next generation. Okay, so we are going to be using this case study in the webinar. We're going to be talking about a very typical family that we work with every day. We work with hundreds of families every year, and it's very common that we have 2 parents, 2 students, maybe a senior in high school, sophomore in high school, very straightforward, maybe high income. Okay, high income, maybe 350,000 a year, paying 62,000 a year in taxes, maybe more. We've got lots of clients paying, earning over $1 million a year, and we've got clients making under 100,000 a year. Again, we want to help all families, but I want to address this high income family that doesn't qualify for traditional financial aid. Maybe they have $100,000 in a brokerage account, taxable brokerage account. Maybe they have like $100,000 saved for college, and maybe they have $500,000 of equity in their house. By looking at that screen, how many of you think they're going to get financial aid? Put it in the chat, yes or no. How many of you think this family is going to get any financial aid from your typical school? Anyone think so? Anyone think so? Put it in the chat. Where we at? Nope, not from FAFSA. Says nope, no way. All right. No chance. And no chance, never, unless smart. Okay. All right. Let's get into it. Let's dive into the details and explain what the problem is. Let's look at this family. Now, I'm using our proprietary software that we built to simulate the FAFSA and the CSS profile. Okay. This family is from Texas. That will help us calculate in-state and out-of-state. There's 4 people in the family, 2 parents, 2 kids, okay? This family makes $350,000 a year, all right? And they have, let's say, $10,000 in the bank with $100,000 in a brokerage account, maxing out one retirement account like a 401k with $100,000 in college savings and $500,000 in retirement. $500,000 in equity in their primary residence and $250,000 in some equity in some investment properties. They have no life insurance or farm or business or annuities in this example, just to keep it simple. And when they fill out the financial aid forms, when they fill out the FAFSA or the CSS profile, it is going to calculate the SAI number for the FAFSA and the EFC number for the CSS profile. If this number is higher than the cost of attendance, then they don't get any financial aid. So if you said in the comments that this family would not qualify for any financial aid, you would be correct. Let's take a look at some schools. We've got some schools that are favorited. We've got UT Austin. Okay, UT Austin is a local state school at $25,000 a year cost of attendance, and they are not going to get any financial aid. How about Rice? Rice is $78,000 a year, no financial aid. How about TCU? TCU, no financial aid. Okay, none of these schools out of state. Okay. University of California, no money there. We've got the University of Texas at Dallas, I believe is the one we've got here. Whoops. Yeah, we'll click on it. Why not? Yep, University of Texas at Dallas. And check this out. Take the cost of attendance minus their SAI number that is made up of income and assets. Income and assets. We take the cost of attendance minus the SAI number, and that would give us our financial aid eligibility, which in this case, nothing. If they did qualify, this school would cover 67% of it and 71% of that in free money. But in this case, no dice, okay? How about going out of state to University of Utah? Also, no free money. So as you can see, because this family has such a high income, they are not going to be qualifying for any financial aid. And if these kids want to go to an out-of-state school, then the problem is with 2 kids at a 5% inflation rate that are planning on, let's say we have a senior in high school and we have maybe a sophomore in high school, and they're planning on going to school for 4 years each. Okay. And let's say that we want to just use some round numbers of 50,000 a year for college. That gives us some options. That's not local in-state. It's not necessarily top tier private. It's somewhere in the middle. Okay. With inflation for these 2 kids, we are looking at $475,000 out of pocket. That's the first cost. Cost number one. Cost number one is the out-of-pocket cost. That's the cost of attendance. Okay. Just shy of $500,000. Just shy of $500,000. Okay. To send two kids to college. Now, if you don't have that much money saved, then there's the second cost. The second cost is if we got a decent rate on a loan and we paid it back over 10 years for both of the kids, we would be looking at loan payments for 10 years each, and that's just shy of $800,000 in what we would call the second cost, which is the financing cost, the cost to finance college. Okay. Now, again, these aren't your numbers. This is just an example. I'm going to show you how to get access to this software so that you can run your own numbers. Okay. Now, there's also the third cost. It's what we call the secret cost of college. It's the cost of missing out. What's the cost of missing out? It's called the opportunity cost. The opportunity cost is that if I help my kids pay for college, instead of investing in real estate or something else where I could get a 10% return over the next 20, 21 years, then this interest, this 10% interest, is the interest I'm not going to get by helping my kids pay for college. That is the cost of missing out. That's the interest that I'm not going to have earned towards my retirement. By the time I have two kids overlapping, I'm shelling out a lot of money that is not going towards my retirement. So this opportunity cost column is for you to show your kids so that they can have a better appreciation of the sacrifice that you're making to help them get the education of their dreams, right? Now, I'm not saying that you shouldn't help your kids pay for college, but this is the impact over the next 20 years on your retirement to help two kids go to a school that costs about $50,000 a year. We're not talking about getting a master's, law school, medical school. We're just talking about a 4-year degree. Now, here's where it gets a little bit interesting. If we deferred the loan payments and took out loans to pay for college and paid back the loan payments over time and allowed our money to work for us at 10% interest, the opportunity cost or the impact on retirement, believe it or not, would actually be less to take out the loans than to pay cash. Now, that's just something to think about, not exactly the topic of our webinar. So I don't want to spend a lot of time on this, but something to think about. You'll hear me say this many times in many of my webinars, but how you pay for college is 10 times more important than how much you pay, but we don't want to pay any more than we have to. So how many of you would like to learn how to get free money for college so that we don't have to reduce our retirement by that much? Anyone ready to learn how to get free money for college? Eric says yes. Awesome. Matthew, yes. Adrian, yes. Bailey, yep. All right. Yep. Yes, please. Thumbs up. Yes, please. All right. Perfect. Okay. Let's dive into the good stuff then. Okay. 2 ways to get free money for college. First, there's need-based financial aid that this family doesn't qualify for. Then there's merit-based scholarships. Okay. Here's how it works. Everybody is somewhere on this grid. Okay. Maybe you're right here in the middle. And if you're right here in the middle, your goal is to work into this bottom left-hand corner. The first and the obvious that you're probably already familiar with is what we would call merit-based scholarships. Now, that is the responsibility of who? The responsibility of the students. Okay? The student needs to get good grades. They need to get good test scores. They need to do something in the community to stand out on an application and an essay, right? They really need to be that exceptionally gifted student. So we want to help these students that are gifted in other ways to become an exceptionally gifted student. I highly recommend everyone work with somebody that specializes in admissions and finding those scholarships that the student is going to qualify for. All right. However, on this particular webinar, I want to focus on what we call financial positioning. Now, a minute ago, I showed you this high income family with savings, with college savings, with brokerage accounts, equity, real estate properties. Okay. They had a high EFC or SAI number, didn't they? That means they might be able to leverage that high number to actually get more scholarship money. I know it sounds crazy, but yes, if you do have a high number, you can actually use that to your advantage to get more merit-based scholarships from the schools if you choose the right school and that school wants your student and has merit-based money to offer. The second option is we want to lower that number. Okay. We want to lower that EFC number and SAI number as low as possible so that we can actually qualify for need-based financial aid. Yes, it's possible for anyone making less than about $1 million a year to qualify for need-based financial aid. We do it every day. We help families every day to reduce their SAI and EFC number so that they can actually qualify for this financial aid. We're going to use real estate and tax strategies. So let's dive into it. How to increase need-based financial aid through what we call financial positioning. Financial positioning is the secret. There are two ways to lower your SAI and your EFC number. Again, the SAI number is calculated when you fill out the FAFSA. The EFC number is calculated when you fill out the CSS profile for a lot of your private schools, okay? The first way is to reposition your assets. If you have $500,000 sitting in a brokerage account or in a college savings account, and you ask the school for some free money, they're going to look at that money and say, you don't need any free money. You've got $500,000 sitting there in a college savings account. We need to reposition some assets. The second option, the second way to lower your SAI and your EFC numbers, to lower your income on paper only. I'm not saying it's time to retire. It's not time to retire yet, but just on paper, we're going to lower our income through tax savings. Okay. Yes, it is possible to lower your SAI and your EFC number to 0 for most people, even if you're a high income family. So let's talk about repositioning assets. When it comes to repositioning assets, there are assets that hurt your SAI and your EFC number. Okay. These are assets that hurt your SAI and your EFC number. So it's as simple as moving those assets to assets that don't hurt your SAI and EFC number. Now, real estate is a little complicated. We'll get into that in a little bit more detail. But there are ways to reposition assets so that they don't count against you and that makes them kind of earmarked for retirement instead of college. It's ethical, it's legal, it's just like these billionaires that aren't paying any taxes. It's legal and it's ethical. You just have to know the rules and you just need to learn how to play by the rules. Okay, so how do we lower your income? That is the secret. Lowering your income is the secret because just by repositioning your assets, if you still have a high income, you're going to have a high EFC and SAI number. Okay, so here's how you do it. Tax savings equals college savings. How many of you would like to learn how to pay $0 in taxes on top of getting free money for college. Could we just add a little win-win to the scenario here? Let's get some free money for college while simultaneously not paying any money in taxes. How's that sound? All right, get those emojis out. All right, put it in the chat if we don't want to pay any more taxes. All right, so let's talk about how to use real estate and other tax strategies to lower your SAI and EFC number to zero, pay $0 in taxes, and increase your retirement income in the process. The secret is what we call depreciation. Okay, depreciation and bonus depreciation is what we're going to talk about. Now, with depreciation, when you buy a residential property, the government says that you can depreciate that over 27 and a half years, not the land, but the actual building. Okay, you take out the land, but you can depreciate the building over 27 and a half years. Why? Because the windows wear out, the flooring wears out, the appliances, the doorknobs, the cabinets, all of that wears out over time. Now, yes, it's true that we know that real estate actually appreciates in value over time. And that's why we love this particular asset class, because we get tax benefits from the depreciation, but it actually is an asset that appreciates. You could also go buy yourself a G-Wagon, or for me, it would be a big F-350 truck, and you can depreciate that as well, but it actually does depreciate in value, whereas the real estate actually goes up in value. So for example, a $275,000 house with $10,000 tax deductions every year over 27 and a half years, that is the tax deductions. Now, this is great. That's fine. I mean, reducing your income by $10,000, that's great, but that's not what we're looking for. We need to reduce all of our income, right? So here's the secret. One of the secrets is called a cost segregation study. Now, this short 30-second video clip will explain it.
This is a cost segregation study. It's a PDF document that's roughly 30 to 40 pages long, and it is the #1 tax saving strategy available to real estate investors in America today. If you don't know what a cost segregation study is, the way it works is really simple. Imagine you bought a $275,000 single family home and we're renting it out as an Airbnb. Now, using typical straight line depreciation, you'd be able to depreciate that $275,000 over 27 and a half years. And so for easy math, that means you could take a $10,000 deduction every single year for 27 and a half years against your income. Pretty cool, right? It gets better. With the cost segregation study, our team of licensed engineers, CPAs, and general contractors goes in and breaks your house down into its individual components. So think doors, windows, frames, cabinets, flooring, siding. We'll break it down to the nails if we have the data. Now, each of those individual assets has a different useful life, meaning a different depreciation schedule as defined by the IRS. And most of them are shorter than the 27 and a half years that you could depreciate your entire house over. Meaning the net result to you as an investor is, instead of taking that $10,000 per year deduction, you could take as much as $100,000 or more as a deduction against your income in year one. Now listen, obviously every property is different and I don't know your unique situation, but these results are not uncommon. We track these results meticulously, and our average client sees $191,645 in year one as a deduction after completing a cost segregation study.
Okay, so we take cost segregation studies plus this bonus depreciation, which, thanks to the big beautiful bill, was just brought back at 100% and is now permanent, which means that we can actually take the purchase of a real estate property, run it as an Airbnb, and we can actually depreciate through bonus depreciation that property off of our income. It's called the short-term rental loophole. It allows us to operate a property as a short-term rental property, okay, an Airbnb, and it allows us to reduce our active income, meaning W-2 income, and your 1099 income. You do not have to be a real estate professional if it is used as an Airbnb. That's the loophole. That's the benefit. Okay. There's the code section if you want to take a screenshot for your CPA. All right. So by using an Airbnb, we are able to purchase an Airbnb, use a cost segregation study and bonus depreciation and reduce our income. Let me give you an example of this case study. This was a school teacher that bought a $290,000 house with 10% down. You don't have to buy $1 million house. If your income isn't $1 million a year or $500,000 a year or $300,000 a year, maybe you just need to reduce your income by a little bit. So in this particular case, this client was able to reduce their income by $87,000. It's about 30% roughly of the purchase price, with the land being the biggest variable, plus a little cash flow on the side as well. Okay, so here's some easy math for $1 million, 20 to 30%, okay, with land being the biggest variable. That means a $200,000 to $300,000 tax deduction. So our family that we're talking about over here, we can now come over here to this scenario, and we could look at what it would be like if we reduced this family's income from $350,000 to $50,000. So we put a small down payment, maybe a 10% down payment, 20% down payment on $1 million property that we use as an Airbnb. And now we just reduced our income by $300,000. Does that make sense? And again, if you have questions, we're going to go through all the questions here at the end. So just type your questions in the chat and we will get to those shortly. All right. Now, what if you make $600,000 a year? Well, then you might want to buy 2 properties, or maybe you want to buy 4 $500,000 properties, whatever the case may be. Okay. Now, that's just one example using real estate. Let's talk about some additional tax strategies. There is a commercial solar program where the government is encouraging everyone to help support renewable energy. And this is a program where you could literally put 0 down, 0 out of pocket, and utilize your prior year's federal taxes to go towards buying solar equipment. Now, let me repeat that. Yes, you can receive the taxes that you've paid over the last 3 years back from the federal government. You can get money that you've already paid back from the federal government to go towards your solar equipment and generate tax credits and deductions. So if you add up the taxes that you paid in 2022, 2023, and 2024, you can use those federal taxes paid as 50% down payment for your solar equipment purchase. There's the tax code. Okay. You can also claim depreciation deductions up to 75% of that equipment. Okay. And you also get a loan for the other 50%, a 0% interest loan, and the lease income covers the loan payments. So now let's look at an example. But just to show you how this is done, you don't even need to do an amended return. You simply fill out a 1045 form, and the money that you've already paid the government gets sent to the solar company. So just as a summary, it is a turnkey solar leasing business. There are already big businesses that have agreed to a 50-year contract that want this solar equipment. So you're going to purchase this solar equipment and lease it to these businesses for 5 years. So they have a 50-year contract. You're going to benefit for 5 years, and you can recover and invest previous tax dollars paid through optimized generation of the commercial solar investment tax credits. All right. And then you can generate depreciation deductions on your solar equipment through bonus depreciation because the U.S. wants to become energy independent. So let's say that you have paid $250,000 in taxes over the last 3 years. That would be, then you would get another loan. You would get a loan for $250,000 because this would cover 50%. Okay. Then you would get a loan of $250,000 at 0% interest, and the lease income would offset the loan payment, giving you a $500,000 solar leasing business that qualifies just like a house, just like your G-Wagon, just like everything else that gets depreciation. This solar leasing business and all this solar equipment qualifies for bonus depreciation at 75% of that 500,000. That means you could reduce your income by another $375,000. Now we have a tax credit to use for the future years. Okay? If we could reduce our taxes by more than what we earn, we can have a tax credit to use in the future as well. Plus, not to mention $80,000 in tax savings depending on your income. Now, the key to this is that if we reduce our income by $375,000, now we qualify for financial aid. Okay? Now, if you want to know how all this applies to you, I know I'm going pretty quick here, but if you want to know how all this applies to you, you can book a free call with us at realestatecollegefundingsecrets.com, and I am going to give you free access to our College Cost Secrets software. And then we can show you how to apply these strategies to save your family money. Let's take a look at our case study here. On the left, we have the family with an SAI number of $99,000. Over here on the right, after we implemented all of these financial positioning strategies to reposition assets and lower our income, we now have an SAI number of $1,300. Now, because we leave a little equity in our house, our EFC number is $3,900 instead of $127,000. So yes, through financial positioning and tax strategies, you can reduce your SAI and EFC number. What does that mean when it comes to the cost of college? It means that at a school like UT Austin, even though it's a local state school, we could still qualify for $19,000 of financial aid, and they would help us with about $15,000 in free money, costing just shy of $10,000 a year out of pocket, versus $25,000 over here on the left. How about Rice? Rice, as a top-tier private school, offers 100% of our financial aid eligibility and 95% of that in free money, with an estimated $71,000 in financial aid scholarship money, making the cost of Rice less than the cost of UT Austin. Now, what about a school like, let's take University of Utah, an out-of-state school, but they only help with 65% of the financial aid eligibility and only 54% of that in free money, meaning that our cost for that out-of-state school is actually more than a top-tier private school. How many of you would like to send your kids to a top-tier private school for less than a local state school? Isn't that cool? Okay. And it's because some schools are more generous than others when it comes to this financial aid. Some of your top tier private schools don't offer a lot of merit-based scholarship money, but they do offer a lot of financial aid. So through financial positioning, we can qualify for that financial aid. Okay. Now, that is to give you an example of how much we could save on the cost of college. But now, what does that mean? Let's go back here and look at our breakdown from year to year. On the left, Before implementing these strategies, this family is looking at paying almost $500,000 for college. Over on the right, they are looking at paying about $190,000 if they paid $20,000 a year for school. That's on the high end. Okay. If they took out the loans, they would be paying back $313,000 in loans versus $784,000 in loans. Pretty crazy, right? How about the opportunity cost? How about the cost of missing out on the retirement? We are talking literally over $1 million in savings on your retirement for this particular family. Okay. Every family is different. That's why we want to offer a free call for everybody on the webinar here. If you go to realestatecollegefundingsecrets.com, you can book a free call and we'll give you access to this software. This software is normally $97 a month. We will give you lifetime access to this software so that we can show you how to reduce the cost of college, and you can use this tool, this software tool, as a way of finding schools that are going to give you the most free money. Okay? All right, let's do a quick check-in. So has this been helpful so far? All right, put it in the chat. Have you learned something new? Okay, have you learned something new? Let me know if you've learned something new. All right, super, yes. Yes, a lot of yes. All right, perfect. All right, we got a lot of yeses. Okay, lots of thumbs up, good deal. Okay, so I know I went through a lot of information and I'm sure you have a lot of questions and I'm sure you want to learn more details. There's 3 ways to learn how to maximize the free money for college in more detail. Number 1, there's YouTube University and webinars. I've spent a lot of time learning some of this myself through YouTube University and webinars, right? There's also paid courses. I've purchased over $300,000 in paid courses over the years, learning tax strategies, learning college strategies. There's a lot of ways that you can learn through paid courses. And then I found over time that the fastest way to learn everything was to work with someone who already knew all of these details, that has a, that specializes in all of these areas. And so I started working more with coaches and consultants. And of course, that's how you can learn the fastest. So we have put together a plan to help you out with our team of coaches and consultants in all of these areas to help you maximize the free money for college. We call this the Creative College Funding Plan, all right? Who wants to be creative when it comes to paying for college, all right? So our Creative College Funding Plan starts with financial aid scholarships. We want to maximize that free money from the schools, and you will get unlimited financial positioning strategy sessions with our team. We have a team of financial aid experts who have been doing this for years, who have filled out thousands of FAFSAs and CSS profiles and understand how to maximize that free money from the schools. If you've ever worked with a tax strategist, they are different than a CPA. Their goal is to strategize on ways to lower your income and pay $0 in taxes. Well, the same is true with a financial aid strategist. A financial aid strategist understands how to navigate the financial aid applications. It's not just a matter of filling out the forms. It's about understanding how to maximize the free money by how you fill out the forms. We want to lower your SAI and EFC numbers. Okay, we'll help you make sure you don't fill out those forms incorrectly, and we will help to make sure we find schools that are going to give you the most free money, right? And we'll show you multiple college funding plans to show you the best strategies and help you appeal your offers once you get the offers from the schools. The next step is we want to work with tax strategists. Now, this is different than CPAs. Of course, these people are CPAs as well as tax strategists that understand things like the short-term rental loophole with real estate, or the commercial solar program, or something we call the tiny home program, where you can actually get 5.5 times your investment in tax savings. There's a lot of tax strategies that I didn't go into that you can get additional tax strategies. But we also want to maximize business deductions, things like the Augusta rule and putting your kids on payroll. Now that we have real estate business, a tax or a solar business, you know, and all these other businesses that you could create in this process, we now have business write-offs. You can write off portion of your vehicles, your house, you know, put the kids on payroll. Like I said, there's a lot of ways to maximize business deductions, which all includes lowering that income, maximizing financial aid. All right. And then finally, a lot of times it involves real estate, because real estate is not just about the tax strategies. Real estate is about cash flow. We need cash flow to pay for college, whatever's left. I mean, obviously, we're going to try to get as much free money as possible, but we might still have to pay something for college. And so what about getting real estate cash flow to reduce our income, reduce our taxes, give free money for college, and generate cash flow that could help pay back college? You would get unlimited short-term rental real estate coaching. We have done for you short-term real estate solutions where you could just invest in a short-term rental property. We have creative financing options where we can help you find a property with a lower down payment and a better interest rate than you would typically get on the market today through things like seller financing. Okay, there's additional real estate training that we'll offer. You can get access to cost segregation studies, real estate tax strategies, and of course, how real estate is going to apply to your long-term retirement plans. So just to break this down in more detail, step one, like I said, is your financial aid scholarships. We want to maximize the financial aid. We want to maximize that financial aid eligibility from the schools. A lot of that's going to be a combination of working with the tax strategists and working with this financial aid expert that understands what the schools are looking for. Okay. What are the schools looking for, and how do we position financial positioning, right? How do we position our finances to maximize that free money? Maybe you're going to need to move your 529 money. So what's that going to look like? What are the tax implications of that? You know, we're going to look at all of that. What are some of the benefits and the best ways of paying for college? We'll look at all of that. Okay, now, then it goes on to the tax scholarships. That's step two. Tax scholarships are where we maximize tax savings. Sometimes we have families that are making millions of dollars and maybe they can't get their income low enough to get free money for college. But what about offsetting the cost of college by the tax savings? If we could reduce your taxes by $100,000 a year, that could offset the cost of paying for a top-tier private school. Okay, so tax scholarships could be in addition to getting free money from the schools. And of course, we'll look at things like the short-term rental loophole and the solar program and some other programs. Also, entity structures. How do you set up your entities? Do you use an LLC? Do you use an S Corp? Do you use a C Corp because you're planning on selling in 5 years? There's a lot of things to consider that we can help you with. Finally, the real estate tax scholarships. How do we use real estate to get free money for college, right? We have done for you options. We can help you find properties that would make a good short-term rental property. We have creative financing options. We can also help you with your long-term plans. Let me go into this in a little bit more detail, okay? Our team has over $50 million in short-term rental assets. We offer an 8 to 12% cash-on-cash return, and we have over 200 properties. Our properties are spread out throughout the United States, okay? Ranging from about $300,000 to $5 million. And a lot of this is done through creative financing where we can get lower interest rates and better terms. We don't just throw these properties up on Airbnb like this, but instead our properties look like this, okay? Our properties create an experience. Our properties are at the top of the market when it comes to short-term rentals. Okay. They put in the putting greens, and they put in the pools and the sports courts, the pickleball courts. Okay. They make these properties stand out on Airbnb. And then you get monthly cash flow, equity, and 50 to 100% of the tax benefits without any of the hassle, without any of the stress. You are just an investor in these properties. Okay. Meaning, if you're a busy W-2 earner and you don't have time to navigate the short-term rental game or the Airbnb game, you can literally invest and take advantage of these tax benefits. Let me give you an example. Let's say you invested $100,000 and you held it for 7 years. The tax depreciation could be around $118,000. That means you could reduce your income by $118,000, which is saving you about $43,000 in tax savings. You could get a preferred rate of 8%, meaning you just get a flat 8% return every month, no matter what happens to whether the short-term rental is profitable or not profitable. You get a flat 8% because some of these properties are profitable in the summer. Some of these properties are profitable in the winter. Okay, that would be $56,000 over 7 years. Who knows how much the value of the real estate is going to go up, but let's just say you get a little benefit of the value of that equity, the appreciation. That is a total of $116,000 over 7 years, in addition to the $100,000 you still have in the house, right? So that is a total of $216,000 that you have after 7 years. So after 7 years, you basically turned $100,000 into $216,000 for an 11.6% return. Not too shabby without having to be involved on the day-to-day basis with a short-term rental property. Now, what if we could add some college savings on top of that? What if we could use these strategies to add another $100,000 of college savings? If we add another $100,000 of college savings, now this becomes a very, very good return on your investment. So we're not just talking about reducing taxes. We're not just talking about getting free money for college. We're talking about getting a good return on your investment so that we can actually help our kids pay for college without having that negative impact on our retirement. And again, if you want to learn more, if you want to meet with our team, go to realestatecollegefundingsecrets.com, and you also get free access to our college cost secrets software. All right. I know I just burned through a lot of information, and I hope you put all your questions in the chat because it is time for Q&A, and we'll dig into some of
we got a lot of questions.
All right.
A lot of questions. Okay, so I'm going to start at the top, and I'll work my way down. I've been getting everyone's questions logged. All right. So Sarah asked, aren't there penalties if you take out a 529 money that's not used for education costs?
Yes, there is. And so that's why we want to add that extra income, because you're going to be penalized on the gains of your 529 accounts. So if you have $100,000 in a 529 account and 50,000 of it is gains, you're going to have $50,000 added to your income, and you're going to have a $5,000 penalty. So we need to offset that extra $50,000 of income through these tax strategies. So again, by purchasing real estate with that 529 money, you're going to offset those taxes and penalties because of the tax benefits from the real estate.
Okay, Lynn asks, yes, my SAI is high, that they only offered him an unsubsidized loan of $5,500. He's going to CSU.
Yep, perfect. So
okay.
What we're going to do is we're going to make changes in 2025. We're going to take the new tax return in the spring, and we're going to go and appeal those offers. Now, you might have to pay full price for the first year or two, but let's slash those prices for the second 2 years or last 2 years. Okay. So depending on the ages of your kids, if your kids are already in college, okay, then we're going to make the changes in 2025. Even though, now hear me out, even though you're going to fill out the FAFSA in the fall, we're going to fill out the FAFSA in the fall, and they're going to look at 2024 tax returns, right? But we're still going to make all these changes for 2025, and we're going to go to the school in the spring with the new tax return, and we're going to appeal the offer.
Okay. Does it benefit me since it does not benefit? Lynn also says it doesn't benefit me since I have residential rental, but I don't make cash flow and I have high income. I don't know if they could, if selling that and doing a 529 exchange, maybe. I don't know. You like tell them what you thought. Your thoughts are.
Yeah. We could do a 1031 exchange. We could get a new property that qualifies. If you have a long-term rental property currently, okay, then that's not going to qualify. So we might need to sell a long-term rental property and buy a short-term rental property that qualifies. Or we could use other money. Maybe we have some money that we were going to use for college. Whatever money you were planning on using for college, let's redirect at least that money to go towards some new real estate.
Does it have to be Airbnb or can it be a long-term rental as well? I think we know the answer
No,
to that.
it has to be a short-term rental property to qualify for the tax benefits. But then let's say that you run it as a short-term rental for a couple of months, and then you switch it to a long-term rental after you've gotten your tax benefits and your college savings. Does it have to stay a short-term rental property? No, it doesn't have to stay as a short-term rental property, but it has to be a short-term rental property long enough to qualify.
Okay, so Victoria, Sean, and DM, they basically, this is I'll combine this one. Does it have that is a deduction for year one, but what happens with years 2, 3, and 4? And does the property have to be in the US?
Okay, so the property does have to be in the US to be able to qualify for the US for these bonus depreciation tax benefits. And yes, this is a strategy that you're going to implement every year that you want to reduce the cost of college. But keep in mind, you're going to be able to take college savings and tax savings to go towards the next property. So you could end up with 4 properties or 6 properties by the time you're done sending your kids to college, which means you've got cash flow from 6 real estate properties instead of giving that money to the college. If you just give all the money to the college and pay full price for 2 kids to go to school, then you get nothing other than giving your kids an education, right? But what I'm saying is let's redirect some monies that we have, right? Let's redirect some of the monies that we have to go towards real estate each year. However, we can also stack multiple strategies. We could do the solar program and the real estate program. There's a tiny home program. There's an equipment leasing program. There's all these other programs that we can stack on top of each other and potentially have enough tax credits to last us all 4 years. It just depends on your situation.
Okay, I have several long-term rentals. Where I cannot change them to STRs? Is it critical to convert to STRs?
Well, if you want the bonus depreciation from the using the cost segregation study and the bonus depreciation, let me just give you a little backstory here. So in 1987, Ronald Reagan came out with the new tax laws that separated active income with passive income. And they deemed that dividend income, investment income, real estate income was all considered passive income. And so you couldn't use passive losses like real estate losses to offset active income like W-2 income and 1099 income. However, they separated out hotels and motels, and they said that hotels and motels are active forms of income. I personally know this because when I was growing up, my grandma and grandpa ran a hotel in Wyoming in the oil fields, and they were waking up in the middle of the night to check people in. It was a very active form of income. Okay. So the law states that if you want to write off your active income, if you want to reduce your W-2 income and your 1099 income, then it has to be from an active loss, which is basically a short-term rental, because Airbnb wasn't around in 1987, but an Airbnb falls under the same category as the hotels and motels. That's the loophole. The loophole is that a short-term rental property is treated more like a hotel or a motel, okay? And it's a way to reduce your active income. Now, if you don't have any active income, if all of your income is passive income, then yes, you could use long-term rentals to offset passive income. But if you're trying to offset active income, it needs to be a short-term rental. Hopefully that gives you a little backstory there.
And what happens if I have a solar lease already?
A solar lease for a residential is not the same thing. In fact, those were pretty much just, those were just destroyed in the current bill, this big, beautiful bill. Okay. Solar residential, all the residential solar is out. Okay. I'm talking about commercial solar leasing businesses. I'm not talking about solar on your house. I'm not talking about solar on your house. I'm talking about you're starting a solar leasing business and you are leasing solar panels and batteries to big businesses like Granger. It's a solar leasing business that allows you to depreciate your equipment, basically. It's not residential solar.
Okay, so the solar thing is permanent in the big beautiful bill, or could it go away?
So I mean, if you take it is permanent right now. They are going to take away the panels in 2 years from now, but they will still have the batteries because here's the reality. The government is afraid of a attack on our solar or on our power grids, so they're really encouraging businesses to implement battery backups, big batteries. So the battery program will be around for years, but they have said that they'll probably get rid of the panels, but that doesn't matter. If you do it in 2025, you've already benefited from it. If you do it in 2026, you've already benefited from it. It doesn't really matter if they change it in the future. You only need to benefit from it once. You only need to do it once.
And you're just investing, right? You're not physically doing the installations, right?
No, it's just more of an investment. It's more of an
Peggy
investment.
asks, yep.
Yeah.
And Peggy asks, what are the names of solar companies? That's something that we'll get to if you book your call.
Yeah, we'll get
Adrian,
into the details in the program. Yep.
Adrian asks, if you have 5 kids and going to be doing college for 20 years, how did it change depreciation plan?
Okay, so if you have 5 kids going to college over several years, then you just need a long-term plan. Now, here's the deal. I mean, can you buy 20 houses? Maybe, maybe not. I don't know about your financial situation. Or you do as many as you can. What if you can only offset your income for 3 years? Well, then you just saved quite a bit of money, right? If you could only offset your income and if you can only qualify for these tax savings and these college savings over 3 years or 2 years or even 1 year, you still saved money. If you can make it happen over all those years, great. It just depends on your situation.
So Jean says, I'm interested in the 529 conversion info. And and also says this is way more work than I'm willing to do. It's like taking a second job. Maybe speak to how we can help with that.
Okay, so keep in mind, most of our programs are very, very done for you, simple, easy to do, not taking a lot of time. Obviously, there are some requirements that we can go over in some more detail on what's required, but these programs are not designed to give you an extra job. Okay, these programs are designed to be pretty much done for you and let us do most of the heavy lifting. And so that is why we created these programs is so that you wouldn't have to have a second job. But it also goes back to what I was talking about earlier. If you just tried to learn all this online through getting on a bunch of webinars and watching a bunch of YouTube videos, it will take you forever. If you want to cut to the chase and get this done fast, then we have assembled a team of specialists in these areas that can do most of the heavy lifting for you.
A few people have asked this already, so you might as well address it. What is the cost of working with us?
So our program to be able to go through these three this is our main program right here that covers these three programs and to get unlimited access To get unlimited access to these three programs, basically it's $49.97, so just under $5,000. Yep.
Kimberly asks, this is getting too complicated. I don't make nearly that much. I'm a teacher and still didn't get any financial break because I've been too smart with my money and have too much in savings and too much equity.
If you just have a lot of money in savings, not a lot of income, if your income is already low, then it's going to be very easy to maneuver some things around, make some changes, and qualify for some more financial aid. The more complicated your financial situation is, the more complicated it's going to be to kind of maximize all that free money. But if you have a very simple situation, then it's not as hard, basically. I was
Adrian
also
says,
I was also going to say too on our $5,000 program, we guarantee $50,000 in savings or your money back. We also have a 12-month satisfaction guarantee. If you work with our team for 12 months and just decide you're not happy, we'll give you your money back. And I want to bring that up because we don't allow everyone into our program. That's why we offer the free call to see if you're a good fit. But if you're a good fit and we feel like we're going to save you a lot of money, then we would gladly let you join our program because we know we're going to be able to save you over $50,000. Our average client saves over $200,000.
a lot of people have asked, is it too late? I had one here. I have twins starting sophomore from Brian. I have twins starting sophomore year in college. Is it too late to use any of your techniques?
So twins, sophomore year in college, is that right?
Twins starting sophomore year in college.
Twins starting sophomore year in college, I would look at this a little bit differently. I would look at this as a way of maximizing tax savings to offset the cost that you just paid for college. All right. So you've already paid for college either out of your pocket or you've already taken out some loans, right? So I would look at this as not so much a college savings, but a way of offsetting your taxes, reducing taxes, saving a ton of money on taxes, and getting yourself into some real estate that could create cash flow for your retirement to make up for the cost of college is the way I would look at it.
Okay. Estimated financial aid is a loan basically from the government. Adrian wants to know.
No, we're focused on the free money. No, not loans. We don't care about those Stafford loans, the subsidized, unsubsidized. We're focused on the free money. We want free money. We want to get the Pell Grant. We want to get free money, all the money, not loans.
Linda said, I learned a lot, but this is still confusing. Allison said, is the only way to do a cost segregation study is to hire a company? And what does that typically cost?
Yeah, so cost segregation studies run anywhere from $2,500 to $5,000. Cost segregation studies are done by engineering firms.
John says, how is it possible to only put 10% down on an investment property? I thought it was like 20%.
It's called creative financing, seller financing, creative financing, DSCR loans, direct service coverage ratio loans. There's a lot of ways to finance a property. The most common is traditionally the 20% down, but there are ways to get into properties for 5% down, 10% down. There are ways to get into properties with 0% down. It just kind of depends on the terms.
Renee says, does it require an LLC that requires insurance?
I mean, all of the properties are going to be insured. You're going to have insurance for a lot of this. But yes, you're going to have LLCs, you're going to have C corps, you're going to have LLCs, you're going to have all sorts of like entity structures for managing all of this.
James says, I'm already working with Cade and have a meeting scheduled to go over the strategy. How do I get lifetime access to signing up again without signing up to get lifetime access on software?
Awesome. Yeah, so just work with Cade. I should have said that earlier. If you guys are already working with somebody on my team, just keep working with that person on the team. Don't book another appointment. It'll just add confusion. So if you're already working with somebody, don't book another appointment. Just keep working with the person you're working with.
Susan says, so I'm divorced and remarried. My son's father will be doing the FAFSA, not me, but we both will be assisting in college. Not sure how this will help me.
So I mean, if you're already going to get lots of free money and you don't need to do anything to get lots of free money and you're splitting the cost of college, then reach out to us and we'll send you a webinar on a better way to pay for college. So if you don't need free money for college through these financial strategies, then reach out to us and we'll hook you up with another webinar.
Renee asked, I don't want to buy more property, just be able to pay for college without breaking the bank or taking out of my retirement.
Yeah, well, understood. I mean, this webinar was all about using real estate to get free money for college, right? So if you don't want to buy any more real estate, you can maybe take advantage of the solar program or some other programs that don't involve real estate. If you don't want to buy any more real estate, there are other programs as well. Or if you're just looking at repositioning some assets or doing some other things like that, it doesn't have to include real estate. That's just part of the plan. Okay. So
Suzanne
we can customize a plan for you.
Suzanne asked, can I do a 1031 exchange into one of your investments?
Yes, for sure. Absolutely.
Samantha's asking if we can get the recording the first 30 minutes. Samantha, I would just say if you go to the link we're putting into the chat, there's actually a video there that summarizes it, like a lot of what Lance talked about today.
Yeah,
Matt,
there's a short video. Yeah, short video on that link.
Matthew asked, my son is starting in fall. Can I get benefit for the next semester?
Yes. So I mean, if you've got somebody starting college in the fall, we've still got to make changes now for the next year, right? Not so much the next semester, but the next year. So we're going to be filling out financial aid forms again this fall. We need to also be appealing. We need to appeal our offers in the spring. So there's a lot of work to be done. Even if you have a student going to school in the fall, there's still a lot of work to be done. And even if it means only saving for a couple years, saving for a couple years is better than no savings at all.
Adrian asked, how long have you been in business? The $5,000 investment is a one-time fee, and is it forever?
No, it's a one-time fee, one-time $5,000 investment, and you get access to our team, unlimited access to our team. And then I've been in the industry for about 20 years, and I started College Funding Secrets about 10 years ago. So specifically focusing on this college niche about 10 years, but I've been in this industry learning a lot of this over about 20 years.
Sean asks, on average, how long does a call with one of your advisors take?
About 45 minutes.
DM asks, so do we buy real estate from your company?
Either that or we can help you find real estate. So we have inventory. We have inventory that you can buy. We can also help you find properties. We can coach you on the right properties to buy. I mean, it just kind of depends on what you're looking for. We're here to help you with your short-term rental business, basically, right? So we can help you by offering you deals. We can help you by having you just invest in one of our deals. We can help you by coaching you on a deal. Just depends on what you need.
Thomas asked, does the cost segregation study work with an already existing rental property?
Yeah, you can use a cost segregation study on an existing rental property. If you already have, now, if you've purchased the property in the last 5 years, it could still make sense. If you've had the property for a long time, then you've already been getting some of that depreciation. And so it kind of depends on when you purchased the property. It may or may not make sense. You know what I mean?
Stephanie asks, is the college savings only applicable to undergrads? Or can this strategy apply to like grad school?
I mean, most of this is for undergrads. Grad school is a whole different animal. For grad school, they don't look at the parents' income and assets. For grad school, the kids are kind of on their own. They look at the kids individually as an independent student. They're only looking at the families, the parents' income and assets for the undergrad.
Sumit says, my kids will start applying for colleges this fall, and we have filed the 2024 taxes and returns. Will you suggest amending the 2024 returns?
That's a possibility. I mean, you can't, I mean, yes and no. Whatever we do in 2025 doesn't really do anything with 2024. So like the bonus depreciation, so bonus depreciation for real estate, bonus depreciation for the solar program, all of these benefits that I'm talking about can't be applied to 2024, right? We can only apply all of these tax strategies to 2025. And so there's really no sense in amending a 2024 tax return unless you did something wrong.
We're being asked a couple times here. What are your thoughts on IUL still to move significant cash assets around?
So life insurance and annuities are very common vehicles for repositioning assets. And if done correctly, they work great, right? So we still need to pay for college. Remember, this webinar was focused on maximizing the free money for college. But we still need to pay for college, right? So if I look over here with my scenario on the right, okay? With my scenario on the right, after I've maximized all the savings, I still have $313,000 of loan payments to make. Okay? I still have $313,000 of loan payments to make. How am I going to pay those $313,000 of loan payments? That's the other strategy that we teach, and we can hook you up with that webinar. Just book a call with us. Ask us about the retirement scholarship strategy. Okay. So when you book a call with us, ask about the retirement scholarship strategy, and we'll send you another webinar to watch on how to pay that $313,000.
Do I need to switch accountants to use your service? What if I like my accountant and strategy for other savings for another savings strategy?
Thank you for asking that. I meant to mention that earlier and forgot. We work with your CPAs. Okay. You use our tax strategists to work with your CPA to make sure that your CPA understands what we're doing. Everybody needs to be on the same page. If you have a financial advisor, we need to work with your financial advisor. If you have a CPA, we need to work with your CPA. If you have a college admissions person, which everyone should have a college admissions person, if you have a college admissions person, we need to work with your college admissions person, right? So if you already have people, we need to work with your
So I was
people
thinking,
to make sure everybody's on the same page.
hold on. I need to, can I use the same strategies to apply for med school?
Yeah, I mean, you can use these strategies to apply to med school, but it's a completely different ballgame when it comes to med school.
A couple
So
people have asked about, can you share any more details on the tiny house program?
the tiny house program is a 5.5 times your contribution. Okay. Can you see my screen?
Yes, we can see your screen.
Okay. So here's the tiny house program. The tiny house program is a 5.5 times tax advantage. Basically, what that means is that what they do is they put all these homes in these big parking lots in the oil fields, and they are encouraging drilling oil and oil consumption in the or yeah, getting oil, self-sufficiency, whatever the word is I'm looking for. And so they need to put these tiny homes in these oil fields for the oil workers. Okay. So there's a tiny home program that the government has. The purchase price of the tiny home is $650,000, but you can invest as little as $50,000. But let's just say that you invested $118,000. That would be your down payment on the $650,000 house. And then there would be a loan of $531,000 at 0% interest over 30 years, making the loan payment $1,400. However, you're leasing this home to the oil fields, and they're going to be paying you $1,500. So, in other words, the lease payment washes out the loan payment on the house, on this tiny home. Okay. So you're getting a little bit of a monthly return, but that's not the benefit. The benefit is that on your $100,000 investment, okay, you could get a 5.5 times bonus depreciation. So let's just do for easy math. Okay, that would be $550,000, right? So if I invested $100,000 into a tiny home, times that by 5.5, that's $550,000 of tax deductions, but with bonus depreciation, giving me about $240,000 in tax savings, depending on the income, obviously. Okay. So that could be a ROI in year one of 203%, depending on your federal tax rate. The point is that it's a very small investment to get a huge tax deduction. And then after 30 years, no, after 5 years. After 5 years, the tiny home is donated to charity and you walk away. So
How
you
is
really
how's that more expensive than a full big home? Like
I
that's
know.
what okay.
I don't know why these homes cost $650,000, but maybe it's because they come in on wheels. I don't know. But that's the program. But you are only putting down 118 in this example, and you're able to reduce your income significantly. But you don't get any appreciation. You don't get any real long-term real estate benefits. It's just a tax play. It's just a tax play. You can invest $100,000 and reduce your income by $550,000.
All right, let's get back on track with some questions here as well. Do you have experience working with divorced parents where one parent wants to go down the path of congregation study but the other doesn't?
That's a great question. I do not pretend to be a therapist. I'm not very good. I'm not very good
Oh.
at marriage counseling. You probably don't want to hire me as a marriage counselor, but
Yeah.
but I would say that it is. I'll give you an analogy. I'll give you an analogy. If I asked you to jump out of an airplane without $100,000, or sorry. If I asked you to jump out of an airplane without a parachute, it's like without a parachute for $100,000. Okay. If I asked you to jump out of an airplane without a parachute for $100,000, would you do it? I don't know if she's able to respond,
Yeah,
but
I don't know if they're still
I,
on, but I think
I, I'm
you
not
kind of
looking
answered
at
the
it yet.
question.
Okay.
All right.
Now,
So
the answer would probably be no, right? But what if the airplane was on the ground? If the airplane's on the ground, that changes everything. Now, you just missed out on a $100,000 opportunity because you didn't have all the information. If you don't have all the information, it's hard to make a decision. So sometimes a spouse isn't going to be on board with some of this because they don't have all the information. So when you book a call with us, I strongly recommend you and your significant other or you and your spouse being on the calls together so that you can learn all of this information together,
or former
right?
spouse.
Former spouse, send them the link. Okay. I'll make an exception for you and you can send them the link to this recording. Just kidding.
Okay, Victoria asks, I had a rental property in Florida, and based on the HOA, property insurance, real estate taxes, I could not break even with renters. So we sold it and bought a restaurant. Our restaurant LLC pays our property's LLC rent. Can we get some depreciation on the commercial property?
So yes, you would definitely want to meet with one of our tax strategists and one of our real estate strategists. I don't know all the details to answer your detailed questions on that, but I'm sure there's benefits, to that. Or we could still leverage some new properties as an investment. Again, if you have failed in the past of being cash flow positive on some real estate, then our done for you option where you just get a flat rate of return every month is a great option because then you don't have to worry about it. So that's just
What do
another
you,
thing.
yeah, that's great. What do you do with current rentals that are paid off and generating income?
You can either keep them or we can do like a cash out refinance, or we could do like home equity loans to go buy more. I mean, if they're a great property and you don't want to get rid of them, then we might just need to maybe leverage them. We could leverage them to get loans to go buy more.
Carol asks, I need a call. What if you have bad credit report, need help fast, daughter already enrolled in WVU, and she's not changing, use 529 for first semester, really stuck.
Okay, so
Can we help them?
If you have bad credit, you're going to want to look into creative financing where they don't use banks. You're working with direct to a seller, like a seller financing deal, and you can avoid banks and credit checks and debt to income ratios and all that kind of stuff. So you may want to look into some creative financing options.
Kathy asks, what qualifies as a short-term rental, and how is it validated?
Basically, it has to be an average of 7 days or less. So you have to rent it out, preferably on like Airbnb or VRBO, so you have a record of it for, paper trail, so you have it listed as a short-term rental, and it has to be rented out as an app for an average of 7 days or less. So that's the key to make it short term is 7 days or less on average.
Yeah, and I think you already answered this. Nicole said, do you still feel using IULs is a good way to pay for college? Um, Adrian says, sounds complicated just to donate to your investment fund and still get all the benefits. Why isn't it considered an investment? You're considered a partial owner?
Yes. Yeah, so if you invest in one of these short-term rental properties in like the done for you solution, then you are a partial owner of that property. Is that
Matt asks, how do colleges look at family changing their EFC from 100 to near zero after starting school?
you had a big business loss? You had a big business loss, right? I mean, a bonus depreciation tax deduction is a big business loss. It can happen to anyone, right? You could start school and lose your job. Your kids, you could have $500,000 a year and be laid off. So it is what it is. It's your situation has changed. Your kids have already started, right? The school wants to keep your kids. So your situation has changed. That's just what it is. That's why we have the appeals process because people's situation changes all the time. People lose their jobs all the time. People's income changes. People have bad business losses all the time. All of that is just life. And so the schools look at it like they would look at anything. It just is
And
what
it's,
it is.
and it's completely legal, and because it's all following the tax law. If
Yeah,
we
you're
sign
just
up, so Sarah's asking if we sign up for the call and determine the real estate method is not a good option for us, are there other options that will be presented to us as part of another program you offer?
Yeah, we have a lot of tax strategies and we have a lot of programs and a lot of things that we can offer you. So book a call. Let's just talk through your situation and figure out what's the best fit for your situation.
Uh, uh, Junto asks, will there be problems with depreciation is recaptured for solar and for STR?
No recapture. If you do a 1031 exchange, I mean, if you sell your property, then there could be some recapture on the taxes. But if you do a 1031 exchange, there would be no recapture. And even if you did sell your property, they can't take the college savings back. So, but there are no recaptures on the solar program and on the short-term rental program as long as keep your money in the real estate and do like a
Yeah, just to
1031.
and just to clarify, like you're not doing any work with the solar program. It is completely turnkey.
Yeah, the solar
Suzanne,
program is turnkey. Yeah.
Suzanne asks, I have a long-term rental that has a lease through fall of next year. I want my 2026 income to be lower for when my daughter fills out the FAFSA in 2027. Can I convert my long-term rental to short-term rental in August 2026 to get all the bonus depreciation and lower my FAFSA income, or do I have to have a full year of STR to get the full benefits?
The tricky thing is if you run a property as a long-term rental for most of the year, you're never going to meet the average of 7 days or less rule. So the longer you have a short-term rental, a long-term rental, if you have a long-term rental just even for the month of January, then you've got to spend the rest of the year trying to rent it out for 1 or 2 nights to try to get your average to be 7 days or less for the year. So the average has to be 7 days or less for the year, which means that you need to kind of plan accordingly and maybe consider another property in 2026 or something. But in that scenario, it wouldn't quite work because if you have a lease through most of 2026, you're never going to meet the 7 day minimum rule.
Okay, Lord says, can you detail a bit? Okay, we already did the tiny homes. How long have you been in? He did that. How long have you been in business? Matthew, thank you. He's booked a call. Sarah, after listening more, it sounds maybe the real estate program is not what we need as we are low income when my husband retires in 15 months, but we have high assets.
Then that's a different strategy. That's just more of a repositioning of asset strategy. And that's totally doable as well.
Gregory, some of our income is W-2 and some is K-1. Can we still use the commercial solar program?
It depends. Yeah, the commercial solar program just kind of depends on how much you've paid in taxes and stuff. We would just have to look and see if you qualify.
Gento asks, how does your program work with multiple kids?
I mean, our program is the same. Once you work with us, we're going to have, I mean, there is an additional $1,500 for each additional student that needs help with the financial aid and stuff like that. Not the step 2 and 3, but there is a little bit of an additional cost on step 1 if you need us to help you fill out the financial aid forms for these additional kids. But you might not need to. You might learn everything you need with your oldest. But if you need additional help in the future for younger kids, it would just be an additional $1,500.
Oh, Kimberly asked, will someone contact me? Paul, if you're still on, Kimberly, I'll send you this information. So we'll follow up with you, Kimberly. Brian, my accountant found a mistake on my prior tax return, which changes my EST to where I might now qualify for need-based aid. I did not fill out the FAFSA at the time because I knew I would not qualify. Now I might. Do I have retroactive options?
Yeah, that would be the appeals process. The appeals process is where we're going to want to get that amended tax return. We're going to want to use that amended tax return to appeal. That would be this down here. We would want to appeal that offer.
Okay, so Servas says, my son is going to be a junior in college and he gets full ride to college, merit scholarship. Does this program help us?
So if you get a full ride merit scholarship, but we could also add financial aid on top of that, you could get paid to go to school. Win-win. So,
Diana, do you need to? Okay, sorry.
well, sometimes full rides are just full rides for tuition only. We still have to pay room and board. So we could still use some of this savings to offset some room and board costs. It just kind of depends.
Yeah, Diana asked you, do I need to switch accountants to use your service? What if I like my accountant strategies for other strategy? I think we
Yeah.
talked
No,
about this one.
we work with your CPAs, but if you need a CPA, we do have some we can help you. We do have some we can recommend to you. But no, we do work with your CPAs.
Yeah, Matthew just asked that question. Do you have CPAs we can work with? Leanna asked, does your price cover all your programs? Like all the things you talked about? Does it cover everything?
Yes. So basically, the $5,000 program covers steps 1, 2, and 3 right here. Yep.
John was asking, is the minimum 50K the tiny home? So you give away the money for tax deductions in short term?
Yep.
Oh,
Yep. You're basically just buying tax deductions and buying free money for college, right? You're investing in the tiny home program to reduce taxes and get free money for college.
okay. What if we don't have a CPA? I do my taxes. Do I
Yep.
do have CPAs you can refer that are already familiar with working with your program and strategies? The answer is yes. Tiny homes, you get the initial. So on tiny homes, Lisa's asking, you get the initial 118K back after 5 years?
No, nope. The home just gets donated to charity. So you literally paid to get tax savings, okay, and college savings.
Adrian asks, how big is your team?
So our team is pretty big. I mean, we have 27 college funding specialists. We have a lot of these financial aid specialists. We have a lot of real estate specialists. I mean, it's by the time you add up the team of the tax strategists with the real estate strategists, I mean, we're probably pushing, 50 to 100 by the time you add everybody up.
Gentos asks, what is the minimum investment for real estate in done for you option? Can this be combined with a qualified opportunity zone?
Usually, on the real estate, the minimum investment, if you're working with us on one of our properties, the minimum investment is usually going to be around $50,000.
Okay, Carol's asked, will you be able to get another call if you need it? Situation is complicated.
Yeah, for sure. I mean, we're here to help. Yeah, I mean, if your situation is complicated and it takes a couple calls to figure it out, that's fine.
Matthew's asking, I assume I get details of CPA in the call. No, Matthew, once you work with us, we'll introduce you to those CPAs.
Yeah. The free call that we're offering is to make sure you're a good fit for our program. If you're a good fit for our program, and if we find that our program would be helpful for you, and if you find that our program is going to be helpful for you, then that's when we would make the introductions to our team.
And the last question there is, how do I book a call again? I've just posted that again in the chat. Do you have college admissions specialists? Dolly's asking.
Yeah, so we do have college admission specialists that we will refer to you. It is not a part of the program, but we can include it. And so we can talk about that if you need a college admission specialist, we can create a custom package for you.
Well, here's an interesting one. Nicole just said, current client here, and they were so amazing. And these strategies worked so well for me. I jumped on board to share these strategies because nobody is teaching this stuff.
Thank you. Is that
That's
Nicole?
Nicole Ryan. Nicole Ryan, yeah. Gupta
Nicole, we love you, Nicole. Thank you.
Gupta K is asking, can you share your cost for each of the three options? Well, go ahead.
It's just $49.97 for it's a package deal, right? Because it all works together. The real estate, the tax strategies, and the financial aid, it all works together. And so it's a creative college funding strategy, basically. It's a creative college funding package for $49.97. So it's not $49.97 for each of the three, it's just $149.97 for the three.
Brian's asking, if the average savings is 200,000, what is the average SA9 number for those folks?
I mean, our SAI numbers are huge when we start. All right. We're helping families to reduce their SAI numbers. I mean, just to show you, I don't think there's any personal information in
Well,
here.
at the end of the day, Brian, we have a $50,000 guarantee. So if we can at least, with all of our strategies combined, if we can't at least get you that in savings, you can get your money back.
Yeah. I mean, our families, I mean, we have over 1,300 families in our software here, and you can see 162,000, 447,000 SAI, 123,000, 99, that was me, 78, 80, 185, 166, 120, 108. I mean, look at that, $885,000 SAI number. So these are, I mean, we are helping families, we are helping high income families to maximize on this free money. That's our specialty. Our specialty is working with high income families to help them qualify for this free money through these strategies that we're talking about. Now, sometimes maybe all we can do is reduce their taxes by 100 grand a year. So if all we do is help somebody save 100 grand a year in taxes, it's still a win-win, right? We're still helping them save 100 grand a year in taxes to offset the cost of college. Worst case scenario, right? And there's a lot of other.
Sorry.
You're good.
Carol's asking, give the number in order to do the booking. It's not a phone number. I just posted it again. It's realestatecollegefundingsecrets.com. Lourdes is asking, does the bonus depreciation also reduce pension and social security income?
Yeah.
BMAC is asking, sorry.
Anything that shows up on your AGI, your adjusted gross income, line 24, we're going to try to reduce that number.
BMAC is asking, do you have college admissions counseling?
Yes, we have. We can recommend to you the best college admissions people out there. We've been doing this long enough to know who the best college admissions people are in the industry, and we will hook you up with them. But that's a separate program.
What is Bobby's asking? What is considered high income family? 200,000?
Anyone who doesn't qualify for financial aid. I mean, if you're not qualifying for financial aid, or if you want to qualify for more financial aid, even some families that qualify for some financial aid just might want to help. We might want to help them qualify for more financial aid. So anybody who makes too much money or has too many assets to qualify for the maximum financial aid, we can help.
Carol asks, how about low income families? Can you still help?
Yes, we can help low income families, but we will help you with different strategies because you might not need to reduce your income. If you already have a low income, then we might not need to focus on reducing your income. We might need to focus on cash flow, making money, getting a better return on your money, like putting together a college funding plan to pay for college. Like there's a lot of things that we can help you with that might not be tied to reducing your income. So again, my mission is to help all families send any student to any school of their choice without having a negative impact on your retirement. So I want to help everyone. It just might be a different solution for you.
Brian says, if it's 5,000 to sign up and you guarantee 50,000 in savings, isn't that a total no-brainer? Especially
It is.
considering that we were already planning to start investing in STR.
It's a total no-brainer. We're trying to
Absolutely.
make it a total no-brainer.
Especially if you're already considering doing this, it is you better, Brian, let's make sure you book your call, dude.
Okay, so Brian, I'll tell you, there's this book. There's this book that's called $100 Million Offers, and it says on here, I don't know if you can read it, but how to make offers so good people feel stupid saying no. That's the goal, okay? Our goal is to create an offer that is so good you feel stupid saying no. Why? Because we want to help you. We can't help you unless you work with us. The only way we can help you is if you work with us. And we truly do want to help you reduce the cost of college. So we're trying to make this a no-brainer so that everyone will work with us so that we can help more people. It's that simple. So
BMAC says, I have my son starting in 2028. When do I start these tax strategies?
yesterday. We always need to create a strategy. I was talking to a client the other day whose kids don't go to college for 12 years from now. And he was already making mistakes that we were going to have to correct in 12 years. So if you have time, let's create a plan now and implement it over the next several years. We might not need to implement your plan in 1 year. We might need to implement your plan over several years. But let's start by making sure that you're not making any mistakes that we have to fix in the future. So you can never start too soon. I had a client call the other day and I said, how old are your kids? And he's like, oh, I don't have any kids yet, but we're thinking about having kids. And I saw your ad on Facebook and I thought I might as well learn now. So that's the best time to start when the kid is not even in the womb yet.
So Carol's asking, sounds great. I don't have the 5K up front. Are there any scholarships? We don't, but we do have some payment plans we can offer you. So it might be worth it, Carol, to book the call.
We'll work with you.
Sumit's asking, what are the risks or potential negative impacts of this program?
Here's the deal. We're trying to make this such a no-brainer that there are no negative impacts. Let's take the solar, for example. If anyone qualifies for the solar program, now you do have to have paid over $50,000 a year in taxes in the last 3 years. So you have to have paid over $150,000 in taxes in the last 3 years to qualify. If you qualify for the solar program, it's a no-brainer. It is literally a no-brainer. If you don't have the time to mess with the short-term rentals and you just want to invest in the short-term rentals, it's a no-brainer as well because it's done for you. My dad was an accountant for a property management company. My dad never owned any of these apartment buildings by himself. He was just an investor in these apartment buildings. In fact, we joke when he invested in the tallest building in Salt Lake City, my dad owns a doorknob in that building, he says. So he doesn't own the whole building. He is just an investor, right? So with real estate, in my opinion, one of the easiest ways to get into real estate is as an investor. So then you don't have to know as much. There's not as much risk. there's not as much on the line, basically. Okay. Now, some of these programs, however, they do require, in order to qualify, they do require what they call 100 hours of active participation, which means you have to put together the guest book and you have to assemble some, IKEA furniture, and there's your 100 hours. Okay. So between you and your spouse, you get to count double the hours. So it doesn't take as long as you think, or maybe you visit the property once. Or in the solar program, you've got to go visit the warehouse where your batteries are stored, okay, to qualify for the 100 hours. So that's the requirement on your end. The requirement on your end in order to qualify for these tax deductions is to put in the 100 hours. That's basically, I guess you could say, I don't want to call it the drop. I don't think it's really a negative. It's just what you have to do to qualify for some of these tax benefits. There's really not much to lose.
What happens if my daughter is going to school in 2028 and she ends up delaying her start by a year?
That's fine. I mean, if you are doing a gap year, if kids are taking a gap year, then it's just going to be a different tax year, tax return year that they're going to be looking at. And again, that appeals process is going to be crucial. You're going to want to go through that appeals process because things will be off a little bit, depending on when you filled out the FAFSA. Kind of depends on when you filled out the financial aid forms.
Teresa's asking, is it too late if my daughter is starting college next fall?
No, I would probably say 30% of you on this call today are probably having a kid start in the fall. So it's normal. We work with lots of kids who are starting in the fall. We work with lots of kids going into that senior year of high school. There's a lot of people that might think it's too late. And honestly, if all you did was save on 1 year, it would be worth it. And these tax strategies can even be applied after college. I mean, your kids could be done with college and we could still apply these tax strategies and real estate strategies.
Is the class tax deductible for business?
The class,
I don't know what. So, Gento, maybe you want to explain a little bit more about that?
not sure.
Okay, can you?
Sometimes,
Yeah, go ahead.
oh, maybe the $5,000 is the $5,000 a deduct. I've heard that. Yeah, I mean, I'm not a CPA. I don't dare say, but you would want to double check with your CPA to see. But in a lot of cases, yes, you could write off a $5,000 investment on your taxes.
Sylvia's asking $50,000 in both federal and state taxes, or just federal tax? How many years combined?
Federal, yeah, just federal and the 3 years, last 3 years.
Lisa's asking how many people succeed in the appeal process.
I've been told by my appeals experts about 70%.
Okay, and DM's asking, can you please explain the solar program? I guess a little more detail on that.
You'll have to
Book your call. DM, we're now like 45 minutes past the hour now. So I think why don't you book your call? We'll get into that.
Just book a call and we'll drill into any details you want.
All right. So we have about over 100 people left on the ball. Let's take any specific, last questions. We've done a lot of questions. Like Lance has just answered probably like 75 questions at least. So anybody have any specific questions left? Anything that's preventing you from booking a call? Because our specialists are going to go over things in detail with you on the call. Going to give you access to the software. We're going to get into all the details. So the question I would have is what is preventing you? What's preventing you from booking the call?
Yeah, that was my question as well. I would ask that question as well. If you're still on the call and you haven't booked a call, now maybe you're just hanging out until we're done and that's cool. But if you are not planning on booking a call, I would love to know what's holding you back. Help me to kind of overcome any objections that you have, because it might be a misunderstanding. Like the airplane analogy, you might be thinking I'm asking you to jump out of an airplane without a parachute. I want to assure you that the airplane is on the ground. It is safe. You can't get hurt. And so if you have any misunderstandings that we can clarify, let us help clarify some of that, so that we can, give you that opportunity to join us on a call and see if this is a good fit.
Yeah, so the confusion is they're saying they don't see a book for the software. You only get access to the software if you get on with one of our team members. That's how you get access to
Yeah.
software. Yeah.
The free software is kind of a gift for meeting with us and getting on the call. We're going to actually use the software with you to run your numbers and to show you specifically your own like side by side, right? So we're going to use our software to show you how much we could help you save on college. And then of course you're going to have access to the software after that.
Matthew is asking, can he get a recording for his friend? Just send the link. There's actually a video there. Speak to that.
Yeah, there is a short video at realestatecollegefundingsecrets.com. In fact, let's just pull this up so people can see. If you go to realestatecollegefundingsecrets.com, there is a short video on here that kind of goes over kind of the highlights of what we covered. And then, of course, you can book the call right down here. All right. And then there's some testimonials. There's an interview that I had with Kevin Harrington from the Shark Tank. There's some testimonials from some of our clients. Yeah, so there's some additional information on here, but ultimately when you book a call with us, we'll be able to go over any additional details you missed out on. So I would send—
And it's free.
Yeah, and it's completely free. So I would send this link to any friends that are interested, and they could watch that short video and then they could book a call.
And then Joanne's asking if we can book with Lance, and that's definitely something that happens later on if you're Lance takes on very specific clients.
Yeah, obviously I only have so much time in the day. I have a pretty big team to help me out, but I am always available if you need me, and I always help my team. So a lot of times, you'll be working with one of my team members and I'll work with them to help. But if I need to get involved to help, I'm always available to help.
How much information do you need to bring to the meeting?
You're going to probably know most of the information we need off the top of your head, but we're just looking for— I mean, if you wanted to have your tax returns in front of you, we don't need any personal information. We're not going to ask for any date of births, or your socials, and we're not going to look at your tax return. But if you want to have your tax returns in front of you so that we could ask you some of the numbers, that would be helpful. And then if you have an idea of balances on some of your accounts, like how much do you have in some of your accounts? And if you do have a 529 account, it would be helpful to know how much of that is in gains versus principal. And you'll have to ask, typically you'll have to call and ask. It's probably not available online. So if you want to know, because if you're talking about maybe moving some 529 money, it would be helpful to know how much of it is in gains.
And that looks like it, Lance.
Awesome. That was fun. What was that? Were we pushing 2 hours? That was like
Yes.
an hour.
Yes.
That was like an hour of Q&A. I think we set a record for Q&A.
Absolutely.
That was fun. I actually enjoyed that. Okay, so go to realestatecollegefundingsecrets.com. Down here at the bottom is the calendar. Book a call with our team, and let's help you save some money on college. All right, thanks for being on. I'm going to go have dinner. Thanks for joining us. We'll talk to you soon.